One of the problems that got us into this mess was that there was a belief among homeowners and lenders that home prices in this country never go down. And you can kind of understand why they thought that, because insofar as we can examine the historical record, the last time home prices went down on a nationwide basis by a substantial amount was the Great Depression. So the assumption had always been that unless you had another Great Depression, home prices would not go down in a significant way across the country. And that encouraged people to leverage up to a great extent. And it encouraged lenders to lend the money to people who probably shouldn't have got loans. Now, as a consequence, when prices inevitably, as they always do, retraced their run-up because they were too high, it essentially left the value of property well below the presumed mortgage value that was issued in order to finance that. So you basically played havoc with people's assumptions, and millions of people literally ended up in homes with mortgages that were worth more than the homes were worth, and lenders stuck with collateral that couldn't be sold to pay off the loan. And we're not just talking about the speculators at the top of the bubble in 2007 who were perhaps knowingly taking out loans that they didn't expect to pay back 100% loan to value. We're talking about people who put down 20% and they've lost that 20%. It's possible that the situation was on a proportionate basis as bad as in the Great Depression, but fewer people owned homes in the Great Depression, and the people who owned homes were less likely to have a mortgage. So in some sense, even including the Great Depression, this is probably even the worst collapse in real estate values and the worst situation in terms of defaults and foreclosures ever. I don't think it's going to get worse before it's going to get better. I actually think we've seen the worst. I think the economy has pulled out of recession. I do not expect the economy to double dip back into recession, but I think that the path back to recovery will be slow and painful relative to the experience you normally would have anticipated, given what we've seen after recessions of a similar magnitude, because of the extraordinary damage to the financial system, which impairs the ability of investors and borrowers to meet up with savers. Given the loss of wealth, which will make people want to save money to rebuild their wealth, given all those things. And also the fact that we do have a lot of bad loans out there which have not been cleaned out of the system. With time, banks can earn their way out of the situation, but what we've seen in the past is that it does take a lot of time. Well, John Maynard Keynes once pointed out that most business decisions are not based on a careful analysis of your spreadsheets of cash flows and so forth, but more a gut thing, almost like an animal spirit's reaction to whether you're optimistic or pessimistic. And so when a business wants to make a new investment or a bank has to make a new loan, to some extent they have to take a view on how the economy is going to perform and whether the asset they're investing in is going to go up and down in value. And so to a certain extent, after what we've been through in the last 2 or 3 years, it's understandable that banks and other lenders are going to impose a much higher sort of safety cushion on their decisions than they would have in the past. Is that psychological? Yes, it is, but it's understandable and it's also predictable. What's worrisome, in my view, is that natural and predictable tendency to overcompensate on the side of caution by bankers is being exacerbated by the regulators. The financial system is pretty resilient. For example, when Washington Mutual collapsed, it didn't just disappear overnight. It was bought by JP Morgan. And so the branches reopened the next day under the JP Morgan name. So people were still there. But I think most small businesses would tell you that, when their bank gets taken over and they walk in as a new loan officer there, they have to reestablish relationships and so forth. And, or even if it's the old loan officer and the loan officer says, well, head office now has new guidelines about how we're going to lend. In Florida, we now need double the down payment that we used to. Those sorts of things are a new thing. That's about trying to recreate relationships that were there before and new rules of the game for the saving and lending process. The United States economy, basically for the last 25 years, you've seen consumption grow faster than people's incomes. As a consequence, savings dropped and we borrowed more and more from countries overseas, and that has turned in a decisive fashion. We simply can't continue that direction any longer. So as a country, we need to consume less, save more, export more. And I think the challenge is especially large for Florida because it in some sense epitomized these very trends. I mean, you had an economy that was disproportionately dependent on real estate and construction. And to a great extent, the in-migration of people from other states to Florida as they approach retirement was made possible because what they would do is they would sell their house in Connecticut or New Hampshire or Oregon or California, take all the wealth that they had built up over the years in that, and then spend it on services, whether it was golf club fees or medical services in their new home in Florida. And that was a very that was a very effective business model for the state of Florida. It made it a very wealthy state. But you don't need me to tell you that it's going to be a lot harder to attract those migrants when so many of them can't sell their homes and so forth, and property values have been as reduced as they have been. The other thing with Florida is that the mirror image of that high degree of consumption is that it's not a big exporting state. And a lot of the stuff it exports, like cement, is sort of geared to the construction industry, which, as we know, is weak. And furthermore, while Florida benefits from proximity to Brazil and some other rapidly growing markets in Latin America, it doesn't have a lot of connections to Asia and some of the rapidly growing markets over there. So in some sense, I think one of the challenges for Florida will be to sort of reach out to and establish some of those markets. I think on the positive side, Florida is one of the biggest tourist destinations in the United States. Tourism tends to be very sensitive to things like exchange rates, and the dollar is very cheap now. And so somebody in Canada trying to decide whether to go to Florida or go to Barbados or go to Europe, it's much more likely to pick Florida now. And there might be a role for the government or the business sector to try and exploit that more, especially in some of these increasingly affluent emerging markets in Asia. At The Economist, I recently wrote a very long feature dealing with the challenges of the federal fiscal situation. And I was very curious about whether there would be a role for fixing it through better new arrangements between the states and the federal government. It was very interesting to hear the frustration from a state legislator's view, albeit one that may be idiosyncratic to this particular legislator or his party. But it was interesting and edifying to hear his concerns, the frustration about having essentially this mandate imposed upon him, and how the option of opting out really isn't an option at all, and dealing with the anger of his constituents of feeling like that they're paying for profligacy in other states. I mean, without making a judgment as to whether that's a legitimate concern, it was very interesting to hear that. To hear Senator Storm's concerns about her constituents who can't get loans, about what can we as legislators do to stimulate job creation. And then over all of this, the clear gloom about trying to balance the budget. I mean, it would be nice to think you had some money to play with to do some job creation, but gosh, you're just trying to figure out where you're going to find the next $1 billion to cut to deal with the shortfall that's coming down before the end of this fiscal year.